Over the last 20 years, more than 9 out of 10 professional fund managers, people paid millions to pick the best stocks, failed to beat one boring investment that a complete beginner can buy in 5 minutes. Think about that. Highly paid experts with teams of analysts and supercomputers lose to something so simple you could set it up today on your phone. By the end of this video, you'll understand exactly what that investment is, why it wins, how to buy your first one, and the one mistake that ruins most beginners. Let's get into it. Let's start from zero. Normally, when people think about investing, they imagine picking a winning company. Buy Apple, buy Tesla, hope it goes up. The problem is that picking individual winners is incredibly hard, and if you're wrong, you can lose a lot. An index fund flips that idea on its head. Instead of betting on one company, you buy a tiny slice of hundreds or thousands of companies at once in a single purchase. The most famous example tracks the S&P 500, the 500 largest companies in the United States. Apple, Microsoft, Amazon, Google, you own a little piece of all of them automatically. In Europe, we mostly use UCITS ETFs, which are the regulated version for us, and many people choose a global index that holds companies from all over the world. The idea is the same. You're not betting on one winner, you're betting that business as a whole keeps moving forward over time. And historically, over decades, it has. So why does this simple basket beat highly paid professionals? The first reason is fees, and it's bigger than most people realize. An actively managed fund where a manager picks stocks for you typically charges 1 to 2% a year. An index fund can charge as little as 0.1%. That gap sounds tiny, but remember compound interest from the last episode. Small percentages, repeated for decades, become enormous. Here's a concrete example. Imagine two people each invest 10,000 euros for 30 years, both earning the same 7% return. The first pays 2% a year in fees. The second pays 0.1%. After 30 years, the low-fee investor ends up with tens of thousands of euros more. Not because they were smarter, but simply because they didn't bleed money in fees every single year. The fee is invisible, but it quietly eats your future. The second reason is harder to accept. Nobody can reliably predict the market. Not the experts, not the gurus on television, not the guy with the confident voice on the internet. Studies that track professional fund managers over long periods show the same thing again and again. After their fees, the large majority underperform a simple index. Some beat it one year, then lose the next. There's very little evidence that anyone can do it consistently over decades. The index fund doesn't even try to be clever. It just quietly owns everything and rides the overall growth of the economy. And by not trying to outsmart the market, it ends up beating almost everyone who does. Okay, the theory is nice, but how do you actually do it? 3 simple steps. Step 1. Open an account with a broker. That's just a regulated app or platform that lets you buy investments. Compare a couple, look at the fees, and pick one that's well known and regulated in your country. Step 2. Choose a low-cost index fund or ETF that tracks a broad market, a global index, or the S&P 500. Look for 2 things: a low yearly fee, often called the expense ratio, and a fund that holds a wide range of companies. You don't need anything exotic. Step 3, and this is the secret: automate it. Set up an automatic purchase every month, the same amount, on the same day. This is called dollar cost averaging. Some months you'll buy when prices are high, some months when they're low, and over time it averages out. More importantly, it removes emotion and guesswork. You're not trying to time the market. You're just consistently buying month after month for years. Let's talk about why owning everything is actually safer. When you put all your money into one company, your entire result depends on that one company. If it fails, you fail with it. When you own hundreds of companies through an index, no single failure can sink you. Some companies in the basket will go bankrupt. That's normal. But others will grow, and historically, the winners more than make up for the losers. This is diversification, spreading your risk so widely that no single event can wipe you out. It's the closest thing investing has to a free lunch. Now the most important part, the one thing that ruins more beginners than anything else. Panic. At some point, maybe soon, the market will drop. 10%, 20%, sometimes more. The news will be scary. Your portfolio will be red, and every instinct in your body will scream at you to sell and stop the pain. Here's the truth. For a long-term investor, a market drop is not a disaster, it's a discount. You're buying the same great companies at lower prices. The investors who build real wealth are not the smartest in the room. They're the ones who don't flinch. They keep buying, automatically, through the scary times. And they let the recovery do its work. Time in the market beats timing the market, almost always. Let me save you from a few classic beginner mistakes. First, chasing last year's best performer. The fund that did great last year is often a poor bet for next year. Past performance does not predict the future. Second, checking your portfolio every day. For a long-term strategy, daily checking just feeds anxiety and tempts you to make bad decisions. Set it, automate it, and look a few times a year. Third, owning 10 different funds that all hold the same companies. That's not diversification, it's just clutter. 1 or 2 broad index funds is usually all you need. Keep it simple. Simple is what actually works here. So let's bring it together. Index funds let you own a slice of the entire market in one purchase. They beat most experts because of low fees and because nobody can reliably predict the market. You buy one by opening a broker, choosing a low-cost broad fund, and automating your monthly investment. You spread your risk through diversification, and you win by staying calm when others panic. It's boring, and boring in investing is exactly what makes you rich. If this helped, the next episode covers the 5 money mistakes that quietly keep most people poor. Number 3 is one almost everyone makes. I'll see you there.